today we're going to talk a little bit about price behavior and liquidity. And we're going to focus on a couple of assets here, oil, S&P, and the euro US dollar. And what I'm going to do is I'm going to just walk through a little bit about how I trade. Just going to mute that one. So in the course of discussing these subjects, I'm just going to go a little bit, talk a little bit about how I trade and what I'm looking at right now for these specific assets. And if you want, I'm open to questions. Feel free to ask me any questions, even throughout the course of the presentation or the discussion. And we can talk about some specific areas of interest. All right, we'll leave a little bit of time at the end for that discussion. So a little bit about me. I've been trading FX for 20 years now. 10 years I spent as a CT, registered as a CTA, member of the NFA, and managed some funds for clients. And that was quite intense. Glad that's over. I'm in semi-retirement now. I back in the old days, I competed in 4 Olympic Games. Long time ago, and we were world champions. But let's just really get up to what's important here. Before we get started, I just want to kind of bring us into context in terms of what we're going to be looking at. So I just want to give you a sense as to my trading framework so that when I'm talking about certain subject matter, you've got a little bit of a sense as to where I'm coming from. Obviously, we're not going to get into a lot of detail because we're fairly limited on time here. And I typically focus on price. I am what they refer to as a price action trader. I know price action is a very generalized term that can cover a very broad spectrum, but the manner in which I have studied price and the lengths to which I have gone to study price, all the way down into understanding how the algos are written in the interbank feeds, as well as how price is delivered and how price passes through the liquidity provider, and what it means for you in terms of what you see on your charts while you're sitting at your desk trading whatever asset you're trading. My primary studies, of course, has been in the FX market. So price action is a lot deeper than a candlestick formation, for example. And it's important to understand that, because when you start to see everything that's going on behind a candlestick formation, it becomes quite fascinating and self-reinforcing. So I'll talk about the presence of liquidity, some of the areas where you can look for liquidity and how price moves from one point of liquidity to another, and how that relates to the character and the changes in volatility. We look a little bit at microstructure, and I typically will use fractal geometry. So that's just a fancy word for saying that the formula that I use and the types of price behaviors that I use for intraday trading or for short-term trading are the same dynamics and the same type of price relationships that I use for swing trading and for my position trades as well. Just that my position trades, of course, are going to have a little bit more fundamental support in terms of what are the primary drivers underlying that asset. When we're going to look at price behaviors today, we're going to look at just some very basic aspects of price behavior. So when I talk about price behavior, I'm talking about one specific behavior. When I'm talking about a price relationship, I'm talking about the combination of behaviors that go into a pattern that becomes tradable, for example, because there's usually multiple price dynamics going on at any one time. And when I refer to market structure, the market structure is really kind of your playing field, your overall macro environment. And so we're trading the price relationships within that macro environment. For example, the environment during payrolls and the market structure and the volatility dynamics during a payrolls data release is going to be quite different from trading during Asian session, for example. All right, so it's just a different playing field is what I want to make reference to. Now, let me first going to get started because I was asked to talk about oil. And I'm first going to start out with an oil chart here. I just want to test to make sure you can see my tool there. And So we're just going to do a little bit on oil. And if you have any questions on oil, I'm happy to cover it. It's probably not the best asset to be trading right now. It's always good to have a few assets in your portfolio because sometimes some are not moving, others have very nice rhythm to them, and others, sometimes the rhythm can get a little bit too dynamic, as you may know. So let's just have a look, and I'm just going to draw out some basic market structure of what we've got going on here. So if you look at the larger framework here, and then within that larger framework, I'm always looking at the bodies, and I'm always looking at the wicks, and I'm always looking at really quite specifically, precisely what went on right at this point right here. I want to see the market dynamics of what goes on here. And then, of course, I want to see how the market corresponds with, so when I'm trading, I'm looking at where in the future price can potentially be pooling, where we can potentially see a price response. So for example, in the future at this specific time, if I'm looking for areas where price can potentially be pooling and an area where we might see a dynamic response in the market, a tradable response. And again, it can sometimes be difficult to contextualize these concepts because some of you just trade intraday, you look for a few points, and others of you will be looking at much longer term position trades. So some of you may have intraday hold times, others multi-week hold times, and other multi-month hold times. But I just want to talk a little bit about where I would be looking for certain types of movements. But the way that I trade is if price is currently trading right here, I would be looking at potential price responses, and these would be some of the types of areas where I would look for the price response. So if price starts to move, if it moves higher, where would I look for short-term trades or volatility to respond? It would be these levels right here. So now if I just go back and looking down at this swing right here, so right now I'm thinking that the oil market can get to the $44 range and then possibly 50, but I want to see the price dynamic at the $44 range. In order to do so, what I want to do here is I want to take you down to the daily chart so we can get a bit of a closer view. So here we are. Let's just look, and all it is in this particular instance, we are just looking at a very simple level of resistance, support, and support becomes resistance. But what I want to do is this is not as simple as it looks, and there's a lot more information hidden beneath what goes on in this little area right here. So this is what we refer to as a clean breaking point. And at that clean breaking point, when we break this down into a smaller time frame, so if we were to take this and zoom in on that level, let's just say, for example, this was the level right here. Let's just take this line. As price, so price had moved down into this level, it had responded, as you can see. So what it did was it came back up here, picked up liquidity. And when price moved through that level, its starting point was not, the starting point was not here, but it was rather, it was up here. So when price moves through this level, once it gets through the liquidity that's sitting at the base and it moves through that low, it enters into a whole new environment of liquidity. And it is typically, liquidity is much more scarce or more barren. And what will happen is price will typically run through, so it will be very thin. It'll run through until two things happen. There will be liquidity resting further on. So down here. So when price breaks through, it's very skinny. Liquidity will sit at that $40 level because of the way some of the assets are priced. You'll see some sitting at $40. there's two things happening. One is it's going from a richer area of volume and it's getting weaker and weaker. The more price runs, the weaker it gets, and then it hits liquidity. As it hits liquidity, it will start to get absorbed, and then it will draw up that vacuum, not because there's an increase in buyers. Yes, there are more buyers than sellers, but it's not as though the buyers increased proportionately. It's that the sellers decreased and they left the vacuum. So price needs to draw back, find liquidity before it continues. Okay, so there's just some very basic things that go on at this specific point right here as price runs and looks for liquidity. So now let's just apply that to what we might see in the future here on oil. If our high here is at the $40 level and price is to move through this level and it runs, and we have a nice, fairly direct move, we are going to see that liquidity has pooled here. There's a few reasons why liquidity is pooling there, and this can apply to any chart. I'm going to take you over to FX in a moment. So this level right here, this is very interesting. So here we have the larger framework I drew out on the weekly chart. This is what we refer to as a tag. Okay. Now the structure behind this tag, price came down, it was capped right here. Then we drew up to, this is what we refer to as a shelf. It immediately came back down into this range, accumulated a little bit, then released. So this is the cumulative release point of this entire structure that dates back to May and beyond. All right. So this is a point at which there was a very distinct psychological shift in the market. And once price started to shift, there's a lot of hedging that's unfolding in this scenario. Price releases. So now price comes back up and the visit time to retest and pick up liquidity was very short, and we released quite aggressively. So I would also look at a level right in here related to this one. But if price comes up and it gets weaker and weaker and weaker, we're looking at fairly significant potential for a bounce here. And then if it gets deeper, I would look for a bounce here. So either one of these 2 points, I would look for price response. And that's just gives you just a very basic sense of what I'm looking for. Now, once price arrives at the potentially tradable level, then of course we're looking for more price relationships to play out that suggest that price can be breaking down or can be highly responsive. But I just wanted to show you in a general sense how we are trading these levels. So we're taking, remember, we talk about the specific price movement, so the single price movement. Then we talk about the price relationships. So it is a combination of price movements. Then we are talking about the market structure. So what has unfolded throughout the course of this sideways consolidation and this entire dynamic, and what is happening now, what's happening on the playing field now, and how do we trade that environment. All right, so that's just a little bit on oil. Let me move over now to the S&P. The S&P is just in the course of breaking down, and it looks like it wants to visit this 30, right around this 3,000 area. It'll start at 30.30 and head down towards 3,000. But let's just break down. What I want to do is I want to have a look at just this leg right here, this move back up, what's forming now, and what we're looking at to unfold over maybe the next few sessions. Okay, so let's just take it down to a 60-minute chart. So here's your look at the larger structure. And we take this down to a 60-minute. And I want to draw out, and it's going to maybe look somewhat similar to what we looked at in oil. Does it look like I'm looking at you guys? Because I'm looking into my camera. And I just want to, because sometimes it's like I'm lecturing you, but I just want to let you know how serious I am about certain points. All right, so we have a larger structure here. This is not just a simple support and resistance. There's a number of underlying dynamics going on in this scenario. Now, let me just go back for just a second. I want to note that this top right here, this top came right into this microstructure. This little area right in here, this is the tag before the release, all right? And that tag, price came down, picked up liquidity, formed, accumulated, formed this tag, then released. So that's where price stalled here, all right? Now, what we want to do is we want to take it over to the smaller time frame and start looking at some market structure in terms of what breakdown occurred here and then what we're looking for right now as well. All right, so are you with me so far? Now, again, if we look at this larger structure, price came up, it hit the liquidity that we referred to on the higher time frame. Price made an attempt here, right here, came back up, and you see how it filled in this skinny move down there. Price had to come back up, pick up liquidity. It went into Asia and picked up a little liquidity during Asia. Now, this is a fairly significant happening. We drew back. See how we came back and picked up liquidity here on this area, and it couldn't get through. So remember, this overall area is seeing a fair bit of resistance with the presence of liquidity and sellers, right? Liquidity is buyers and sellers. Now, let's have a little bit of a deeper look at what happened here. We had what I refer to as a Fed reversal, and I was speaking to some of the dealers, and I said, given that we are at this point of resistance and we are forming a reversal type scenario, post Fed, we're probably going to see a bit of a rally, and then if it closes below the pre-Fed time, then we're probably going to make a good run to the downside. So this right here is the dynamic. Then price closes below. So this was your last attempt at the highs. This was a very weak move. It responded quite sharply, which meant two things. The move was weak and liquidity was present up here, more sellers. So what would have happened is this. We would have had what we referred to as a price run, and that is a release to the upside. There's a bunch of dynamics that underlie this, but price runs very weak, so liquidity gets weaker and weaker and weaker, creates a void, hits liquidity, and then price just draws back. When it trades below, then you're looking at a significant move to the downside, particularly because the market structure is because it is a Fed-driven event. And when the Fed makes a statement and price volatility starts, once the price action plays out, you need to get out of the way. Usually you don't want to trade against that movement. All right, so let's, so again, that's a little bit more information on our market structure. So as price is falling, it hits a couple little liquidity pockets right here. Okay, and right here, we hit a liquidity pocket, price draws back up. And so here you've got a tag, right? Price came right up to this wick and responded quite sharply. That tells us, so you could have different scenarios play out here. Price can fall, accumulate back over a lengthy period of time, and then break down. Or you can have price just come back up, hit the first little bit of liquidity, respond. That typically implies we're going to see a more aggressive movement. So here we see price pop up, just hits the clean breaking point on that wick right there, and then responds. That usually implies a significant move to the downside. So now let's have a look at some of our market structure, just looking at just some of our areas. So there's a couple areas we look at here. We're going to look at the wicks, the bodies, and then the point at which the market really decided to move to the downside. Now, there's a little spot right here as well. You can see the overlap in there. And then there's some here. All right, and then there's some here. And you can see as price draws back up, we respond at each of these levels. All right, and then price draws down again, and you can see how price, here's a reversal formation. Price went liquidity seeking to the downside, comes back up, picks up liquidity, comes back. So price moves like this. Price moves from one point of liquidity to the next point of liquidity, to the next point of liquidity, to the next, to the next, to the next, to the next. Okay, that's how price moves. And the volatility in between forms new pockets of liquidity that are quite sensitive. So that is what's happening here. Now, as price draws back up, you can see the price response at each of these points of liquidity. Here we have a very weak move. You can see a single candle. Price draws all the way back. So as this candle rises, it gets weaker, 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 comes all the way back, picks up liquidity, runs to the upside, stalls a little bit more. As it pushes through, then look what happens when it breaks through this high right here. It enters into a new state of liquidity, so it pushes to the next level, stalls, pushes to the next level, comes back to the last level, all right, pushes to the next larger level, all right, and now we're just consolidating. We're just consolidating at the moment. So let's take this down to a little bit. Let's see what. Let's just take it down a little bit, or let's take it out first. Now this to me looks like we are, I thought that perhaps we could make one more run up to, I thought we might get up to this level right up here. So one last run up to this level here would be good if we could, but otherwise, if we start to break down, here's what I'm looking for. Now, the reason why it's important that I trade S&P sometimes, not as much as FX, but what I'm looking for is this. Because I am long dollar Canada and short euro. So what I'm looking for is if this price comes down, it still has to eat away at the liquidity right down in here at this base. If it comes down and eats away at it, forms a tag, and releases through and does something like this, then I'm going to anticipate that the equities market is likely to continue to move lower. So we'll probably see it run down here towards 3031, 130, sorry, 3000, just for starters, just in the days ahead. That's what I'm looking for. On this one, obviously right now it's late hours and we're just sideways at the moment, but that's the type of price behavior that I'd be looking for. Now, I want to take this a little bit deeper on the euro dollar, and then we can open it up to some questions. Just wanted to give you a little bit of framework there on the S&P first. Let's take it over here. Now, maybe there's some questions. No questions just yet. Okay. So here's what we're looking at in the euro. Now, price volatility right now is fairly low, and it's going to take, over the years, we've gone through many phases as to the correlation between equities volatility and FX. We've had very strong and very profound correlations between equities markets and foreign exchange. And then other times we've gone through very lengthy periods of almost no correlation. at all, or very, very little correlation, particularly as interest rates became so compressed and so low. There was not a lot of yield advantage, so we were not seeing a lot of FX flows toward yield. So what I'm looking at right now here on the euro is I'm always looking at the bodies, and I want to see the price dynamics at the bodies. And you've got, this is what a retest wick. So if we were to break down this wick right here, you'd see little pockets right up in here, little pockets of liquidity on this wick. And that's what you'd see on this one right here. And that's what we saw, that one last attempt. Also filling a little bit of a liquidity void. There's what we refer to as a void of liquidity that exists in certain areas of the marketplace. What that simply means is that price will, it's a new state of liquidity. So once again, if I look at, if price is moving higher and we hit a level of resistance, when it moves through that level of liquidity, so the liquidity that exists in this area here is very voluminous, very efficient, very stable. And then once you get a price run, then, and there's a bunch of dynamics beneath the price run, don't have time to go through it now, but you can check it out on my website. But when price moves into a new state of liquidity, it's going to have to run. So it starts out and it pops through, and you'll see disparity in price. So you'll see tick frequency increase, and the price gaps will widen slightly. That is because the investment banks, where there are prime brokerage FX dealing desks, each of the banks, they will adjust how price is delivered to the market on the sell side. So they will actually just slightly widen the spreads a little bit. And if you've got all the banks doing that, you typically have more prices jumping a little bit more, as well as more disparity and price. So this is a daily chart on the euro is what we're looking at right now. Okay, and I'm going to scale it down to smaller time frames as well. All right, so we have, so the euro's come up and made an attempt at the high. It came up, hit liquidity up here. We're going to show this on a lower level. But really what I'm looking at right now is we've had some fairly definitive range type activity. Now we are, not only are we closing below, but we've just popped through that big figure. So it's kind of cleaned out a little bit of options. And what I'm looking for now is I'd be looking for any kind of little rally to be selling into. I'm extremely mindful of some of the market dynamics going on down here. So you see, and making trades is not all about what's happening right now. A lot of it is about the market structure and where liquidity might be pooling and where some of the price dynamics are likely to occur. So I'm looking over here at some of this price structure, and I want to see right here was the center move after cleaning the books on both sides of the market. We have price releases to the downside right here, and you can see there's a fair amount of liquidity in there. Price comes up, hits that spot, winds back up, and then releases to the upside. So right in here, I'm anticipating that we're going to see a price response if price moves lower. So if I'm selling up here probably on a swing trade basis, I want to be probably taking something out down around this area. I may even, depending on the nature of the price move, I may even want to take a short-term long position down in this area right here. What I would do is I would take this down and I would zoom in on what this market structure looks like on a 30-minute chart, 15-minute chart, just to get more detail on it. But it's probably an area where I'd be looking to take a long position just on an intraday trade, looking for 20 or maybe 30 pips. So it's 111.35 area. So maybe taking it back to 180 or so. But let's just have a look at this because I want to get into a little bit more detail. Let's just have a little bit closer look at what's going on in this area. I'll get, there's a question here on order blocks, and I will discuss that in a moment. Okay. Let's just take this down. I want to take it down to, this is a 90-minute chart just because it gives us a pretty decent view of what's going on here. On the 60-minute, we don't have enough, we can't quite see enough. So I'm just going to take it to the 90-minute and just give you a sense as to what I'm seeing and one of the reasons why I am bearish the euro, at least for the short term anyway. I think really we're a little bit more on the range bound side, but I think we're going to see some pullback. And I think right now maybe FX is just slightly leading the equities markets. But I'm not looking for this massive move to the downside, okay? Not to be misunderstood, because we always have to contextualize what we say here, because if someone says, where do you think the euro is going, up or down? Do you mean in the next 5 minutes, in the next 3 days, in the next 4 weeks, 4 years? You know, so it's all a matter of context and the person's own individual interest, all right, and interpreting it according to the individual's interest. So let's just have a look. As price, there's a few things. So as price, there's a few points that I'd look at. So you can see here a very distinct tag right here, and then price releases. We see how price came up here and it came all the way back and fed into, it picked up liquidity right down here. Price came all the way back. So it didn't leave what we refer to as an inside gap. So now what we're looking for is, so price comes down, picks up some liquidity here. You can see the accumulation here, but this moved lower than this. The next time price comes down, it hits into liquidity, but price moves lower. So what that tells us is that price is slowly breaking down some of our core areas where we could see some buyers. It moves lower here, doesn't come back up very much, only here, before moving lower yet again. And as it moves lower, remember, as price moves lower, we're looking for liquidity. It's getting weaker and weaker and weaker until it hits our next area of liquidity, which is this point of release. All right. Now, price, this right here, I want to show you, this is important. You see this movement of selling. You see this movement where price is drawing back up. This rising movement is just drawing back up because of this, the lack of liquidity available in this area. So it's coming back up, searching for liquidity. You can see it responds here, then it responds up in here, and then up in the thicker area. You see how thick it is right here compared to the thinner spots. This one is smaller than this one. So what does this partially mean? If you're looking to sell, I'm looking to sell in the very thick areas and at very definitive points rather than the smaller areas, okay? So let's get back to our point at hand. Price comes up, it forms a breakdown process right here, a very decisive point fed, swept the books both sides and distinctly moved to the downside here. So in the future, we look at that level. You see how price came down, clean breaking point, right back up, picks up liquidity at this base, and then falls aggressively. So this whole reversal formation, then we come back up. You see how price hit this exact clean breaking point. You see how short-lived this up move was, and then it came down and traded below. I talked about that earlier. I know I'm throwing a lot at you, and I'm referring to things that I discussed even just 10 minutes ago, and I don't want to lose you here. But for example, what happened here, remember, you've got market structure, the whole playing field, taking the fullness of what's going on in the market into account, the breakdown in price here. Now watch what happens right here, okay? Price comes down, feeds back up in here, and then it creates a release point to the downside right at that point. Now let's watch what happens right in here, okay? Price does this, goes down, comes back up, sits like this. So remember, market structure is to the downside. Price comes up, hits liquidity, comes back, and starts trading below. What is the market telling you? What is the market telling you? There was no follow through on this move. It only had to touch a very small amount of liquidity, very small amount of liquidity for price to respond and come back and not only trade below this core area, comes back up, retests, moves lower, okay, but moves lower, another reversal formation, all right, here, more reversal formation, price breaks down, comes back up, retests, now it's sitting down below the core of this area, and it's even gone deeper. So remember, deeper, 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 deeper. So it's breaking down all of this liquidity. Now, remember what happened here? Price goes up, comes down, retests, breakdown. Okay. Sideways, price goes up, down, retest, down. It is the exact same pattern that we saw here. This pattern, which is the same patterns of self-similarity, it's called fractal geometry, patterns of self-similarity on a multitude of scales. So that same pattern has been witnessed. This entire pattern is the same as these two patterns. So we are trading the same patterns just on a different time scale, same patterns of self-similarity in terms of market dynamic, but on a different time scale. So I'm using the same type of price dynamics on intraday trades as I am for longer term hold trades and managing those long-term hold trades. So I'm managing the same. Of course, there are a lot of underlying dynamics, the fundamental environment, and of course, the core of price behavior does get in much deeper than a 40-minute lesson. But this is what we're seeing. And I always want to know where price went, and of course went to exact market structure. And it's not just a simple question of support and resistance. I want to know really quite specifically what has gone on here. Now, this area that market worked through that liquidity, now it's hit the next area of liquidity. And then you've got here, but this breaks down into many, many pieces. You can see, okay, apologize for the sticky hand. Price goes from one point of liquidity to the next, to the next, to the next, 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 next. Didn't come all the way back, just came to the wick. What does that tell you? Price is aggressive. Then we move aggressively to the upside. So there's obviously a lot of quirky other contributing factors. Now let's take it down to the 60-minute chart, and actually let's take it all the way down to the 15-minute chart. So what is the market telling us now? You see how we're seeing the same type of price behaviors. This is a 15-minute chart. Price tries making highs on the day, fails, breaks down, comes down, price comes up, back, hits liquidity, rises, hits liquidity, tries again and again and again, finally breaks down, comes back in, fills, this is a, you see right here, this is an extension, new state of liquidity, price comes back to pick up liquidity, then goes. That's what happens here, and that's what happens here. Now you see we have some structure here. price tries getting through, picks up liquidity again. You see how we formed this tag. I referred to it earlier. We have a tag on the base of this whole area. Price releases to the downside, and that's why price is stalling here. Given the late hour, we could, at the open, what happens at Europe open is if price remains in this area right here, price can come up to 1240, draw in a lot of buyers. While it's drawing in the buyers, it leaves a void. It takes the liquidity on the order books, hits liquidity at 1240, then sells into this void and starts to pressure the downside and work its way to the downside yet again. It's a quirky little thing. See it all the time, all the time. So that's why you don't chase the market. That's why, just because we say in a webinar that it looks like euro is going lower, and here's some of the structured reasons why. We're going into Asian, we're getting a close in New York, Asian session. When London opens, then you could easily, traders can take their books up to 1240 and then sell off from there, because two things happen. It cleans out the buyers, hits the sellers, and they take it. And then price moves lower more rapidly because the buyers they've created a void of buyers, and there's no more buyers until we get to the pooling down in the deeper level of market structure. All right. So just a few thoughts to leave you with for now. And so that's pound yen, and here's pound dollar. And okay, do we have any questions? I had a question here. How do you execute order blocks? I have seen that entering simply with a limit order is a hit and miss if the momentum is too strong in the opposite direction. Okay, there is a video on my website, protradersclub.com. I don't even know if I gave it to you. I don't even have it. Protradersclub.com is where the video is. I can maybe see here. There's a video on there that's called Last Look. There's a number of videos, but one of them that kind of discusses to the point that you're referring to is that that video on Last Look. So you may want to have a look at that one. Let me just so what happens is, as if you're, let's say, for example, I'll just go through this very quickly. But if you have an order, if you have a limit buy order down here and price is drawing down towards that level, as price gets towards the thinnest, remember the best bid, best offer quote on your screen is just that. It's the best bid and the best offer, and it is the thinnest condition of the markets, the thinnest level of volume at the market. And there's a very lengthy discussion in terms of how a lot of the liquidity quoted is fake, because a liquidity provider will send out their liquidity to 20 LPs. And when, as soon as it gets hit, then it withdraws it from all the other LPs. And then that gets into, if somebody executes within a few milliseconds and they don't get that price that's been offered by that liquidity, then it goes into last look if the provider uses last look practice. So they change how the nature and the dynamic of the price movement at certain areas. And then, so if you're looking at putting a limit order down here and price is getting a bit skinny, then it's usually not going to pick up your order, depending on how the LP works on your platform. But So the other thing that you may want to do is, and if you're doing market orders, for example, you want to have a tolerance, a PIP tolerance, because you want liquidity to come to you. You don't want to push your liquidity into the market and have the market dynamics give you the prices that the market offers. You want the market to take your prices, okay? And all that's also discussed in that video as well. So that video is, let's see here, it's on this website here. It's protradersclub.com. That's my website. So if you want to check out, there's some free videos in there if you want to check it out. Okay. So price pushes to the low liquidity state to the other, from one point of liquidity to another. The question is why we call them low liquidity state consolidation. When in these areas we have high volumes of demand and supply, which means high liquidity. It depends on how you're measuring your liquidity. So it depends on if it's by transaction, by volume, or by price, because any lengthy period of time, usually what happens is the liquidity is more or less immediately identified, typically by the tick frequency. But so this can when we, let me find a smaller time frame here. So if you look at this, we have a 1 minute chart. So here, this is a 1 minute chart. And here you've got these little pockets, and you can see you have a larger pocket here, smaller pocket, and then now a smaller pocket. Here you have a larger area. Within the larger area, you have all these smaller areas of liquidity. So you will notice that we have increased volatility. So liquidity and volume typically picks up when we start to see the price movement. And when you see a lot of wicks and up and down wicks, you see increase in volume. So price is moving from one area of liquidity to the next, okay, on a smaller level. But each time it gets into one of these consolidations, it goes into a very low liquidity state. When the market goes into a low liquidity state like this, tick frequency drops off, overall volumes drop off, and then all it takes is for, if this is volume and this is volume, all it takes is a little bit of a surge in volume for price, and there's a lack of liquidity here. All it takes is that little bit to get price moving. Once price starts to move, then the dynamics and the underlying pricing mechanisms change. They change how they deliver prices to your chart sitting at your computer, and how the feeds come in to your LP. And then that's when price moves. So you'll see an increase in volume in these areas because transactionally, it's got to start to shift. So this is because when you say low liquidity state and you pose this question, what you're asking may not be what I'm explaining. So when you look at a low liquidity state and I look at a low liquidity state, we can be looking at two different things. So if you look at this overall, yes, we are overall in a low liquidity state, but right just prior to the price surge, market even moves. And look at how small this movement is right here. Okay, price comes down, picks up liquidity, and then moves. Usually preceding these moves, if you look at it like on a tick chart, you're usually looking at, if I were to take this and put it into a magnifying glass, this little area right here, on a tick chart, it would look like this. And then it would be just like this, just for a few moments. Then bam, it has to run looking for liquidity. So then it runs further, it goes to the larger, all right? Then back up, to the larger, then back down to this level, okay? And that's just some basics on how price moves. All right, so question is, which recommended time frame do I use? For my intraday trades, I'm typically making my trade selection off anywhere from a 30-minute to a 60-minute, but I'm actually studying price. I know my levels, so I'm studying the price behavior on the 5-minute and below to see what's going to play out. For my position trades, I'm usually looking at overall macro market structure. I'm looking at what's happening on the daily levels, but I'm still executing my trades based on some smaller time frames, 60-minute and below. But I want to have good market structure on the 60-minute, 30 to 60-minute, good market structure within the framework of the daily chart. And then I'll make my execution, really on what's going on the 60-minute and less. Okay. Well, very good. So it's been a pleasure hanging out with you all today, and I hope you were able to gain some value in the content, and I appreciate it. If there's any final questions. No? Okay, thank you. Thank you very much for attending today. And you can come visit us at Pro Traders Club, and there's an area there with some free videos. I've not updated them in a little while, but you may find some value in the content. Yes, the liquidity means buyers and sellers, and the voluminous of the buyers and sellers, or the efficiency of the buyers and sellers. Yes. If you have any questions later on, maybe after reviewing the video, then you can ask the questions, ask me some questions through the website. So when we refer to low liquidity, the question is, does that mean that the market is not profitable at the time? It simply means that that the market is usually in a little bit of a consolidative mode, and sometimes it will move from one consolidative mode to another. It doesn't mean the market spends the majority of its time in a consolidation mode. At least 80% of its time. There's a range between 80 to 95% of the time the market price is overlapping. It does not mean that it's not profitable at all. It just depends on how you structured your trading framework. Some of the content today might have been elementary for some of you who are more experienced, and for some of you it may have been maybe a little bit too much, or too much in too small a period of time. I do not use any indicators at all. I use zero indicators. This blue line right here has been on my template for over a decade for sure. And it's only there just for cosmetic purposes. Let me see, it's not really on all my templates. Maybe it is. It's just a 34 EMA. I don't use it at all. Question on efficiency. When we refer to efficiency, the market can move like this, or the market can move like this, or the market can move like this. So this would be inefficient, this would be modestly efficient, and this would be more heavily efficient. But inside, contained, this gets into fractal discussion. Contained inside this movement, you have a multitude of these. That's fractal. So we can't even enter that discussion now. But that's when the market gets super fascinating. I can't even begin to explain it, how amazing the price relationships are. Intraday, because I'm a male and I can only do one thing at a time. I typically will focus for intraday trading on one or two currency pairs, or if I'm trading the S&P, I'm usually just trading the S&P if I think the market environment is good. So I'm not sitting on looking at 12 currency crosses. You'll find that my members will note that I'm only studying a certain number of currency crosses, as well as oil, gold, S&P. We do look at FTSE, of course. So I really try to keep my scope as limited as possible, because you only really need to find your niche in the market. By running around looking at a multitude of assets, all you're doing is you're spreading out you're diluting your skill set, or lack of skill set. And the more you lack in your skill set, the more you are compromising your ability to be productive. I'm not a believer in having 20 currency pairs and scrolling through them all. I don't subscribe to Elliott Wave at all. I don't. It's just far too interpretive. I don't, like I say, I don't use any indicators at all. So, and I'm not one to say what is the right way to trade and what is not the right way to trade. It depends on your aptitude. So for example, but if you understand price and price structure, then wherever it is you deviate to, then it will only help. So if this is the entire marketplace, however it is you decide to trade, however it is, you need to go through a process of connecting your brain and the uniqueness of how your brain works to that of the market environment. All right. And you have to go through that process, because the point at which your trading is really going to take off is when you become an independent thinker. That's when it goes to the moon, when you don't rely on chat rooms and forums and other people's strategies. We teach people how to trade and how to engage in a process to develop their brain such that they become their own greatest secret weapon. So if this is all there is to learn about the marketplace, and this is the area you decide to focus right here, that's all you need. As long as you find your avenue into the market to draw money out, it doesn't need to be validated by anyone, but you do need to understand, and you do need to eventually match your unique brain to that of a specific niche in the marketplace. For more information on that, there's a video on my website called the Developing the Trader. I did it here for XTB. And thank you so much, XTB, for allowing me the opportunity to share with your folks. And I really appreciate that. And we did a webinar with XTB some time ago about developing your trading. So you may want to have a look at that. I think it's a very valuable video. If you think it does not apply to you, I assure you that what is said in that video absolutely 100% applies to you and every trader that goes through the process. Okay. So thank you, everyone, Thank you, Evelina, so much for hosting, and it's always a pleasure. Your group is very respectful, and I want to thank those of you in the chat for being respectful and for asking genuine questions and for showing genuine intent, and for not disrupting the discussion. I really appreciate that. And, for that reason, I'm certainly happy to continue to provide information for you all. So thank you very much.